Despite flat lending rates, banks' margins may be squeezed by rising deposit rates during Q2 of 2023. As a result of higher costs of deposits, banks are likely to see their net interest margins, that is NIM, further compressed in the second quarter of the current fiscal year, that is 2023-24. As of April to June 2023, banks NIM, the difference between the interest earned and interest paid, declined sequentially. In April to June quarter, banks are expected to maintain a healthy profit after tax, that is PAT, with slippages under control. Deposits are expected to rise by 12 to 13% in the quarter, while credit costs will remain stable. In spite of rising cost of funds, lending yields will remain stagnant with little benefit from MCLR, that is margin cost of funds based lending rates, linked loan repricing. As a result, banks will continue to experience margin compression in Q2 FY24 as well. Nevertheless, the quantum of compression may be marginally lower for few banks. During the first quarter of the current fiscal year, systemic NIM showed some declines on a QOQ basis due to an adjusted rise in yields and rising cost of deposits. Although card deposit rates have been relatively stable, deposits repricing has pushed up outstanding costs of deposits. There will be a 10 to 20 basis points dip in net interest margin in the July to September quarter of the current fiscal year, which may lead to a weak quarter with core earnings falling almost by 9.3% on QOQ basis to the tune of almost 45,400 crores. It is expected that banks' credit growth will be around 15% for Q2 FY 2024. Despite adverse asset quality trends, there is no need to panic as such at this point of time, as slippages are expected to remain very well under control and asset quality improvement is expected to continue, and they may yield good results going forward in the coming quarters. Thank you very much for your patient hearing.